And it's not the first time that we've done changes in the R&D scheme. We seem to be doing a lot of them at the moment because there does seem to be a lot of changes. We're mainly concentrating today on the merged scheme. So this is a scheme that comes into place for accounting periods that start on or after the 1st of April 2024. Hence why we're trying to get it in today. I am joined by a couple of my colleagues who will be taking us through some of the main points of the scheme. So we've got Sean. Sean, would you like to introduce yourself?
Yeah, hello, morning. Some of you may recognise me from either working with me or from the last webinar. Been at MPA for 5.5 years as an analyst, specifically focused on IT companies. Now I head up the analyst team. So we'll be working closely with you through these merge changes, and we'll be best placed along with Richard, who will introduce himself in a minute, to kind of navigate our way through it.
Excellent. Richard, please introduce yourself as well.
Okay, so I'm Richard. I've been with MPA for 5 months now, but I have a background in corporation tax and helping businesses with their R&D claims, and yeah, the ever-changing world that we live in when we're talking about innovation reliefs.
Great. I'll introduce myself. So I'm Samantha Wildman. I'm Group Client Director here at MPA, and I've been working with our clients now for over 11 years, supporting SMEs on their innovation journey. I do tend to host most of the webinars, and they don't tend to be as stressful as the start of this one has been. Holly, could you put up a poll? We just really wanted to ask some questions and get some feedback on where you are with your understanding of the R&D scheme. So if Holly can, she's going to put a poll up. Hopefully that's there for you all to see. If you can just take a minute to answer that.
Okay, so on a turnout of 79%, which is very good, thank you everyone. Those who are very familiar, 0%, somewhat familiar, 20%, but by far the winner, not very familiar, 53%.
And it's not surprising, really. Thanks, Holly. If you can put the presentation back up. It's not that surprising. I mean, a lot of these changes have come in so quickly, you know, one change after the other. I mean, the actual signing off of this merged scheme sort of only happened within weeks before it happened to come live. So we're also still seeing HMRC bringing out guidelines on how some parts of the schemes will work as we go on. So just to take you through what we're going to cover on this webinar, we can go to the next slide, Holly. It's really going to be more about what you need to do for the changes from this April. So we have talked about changes that came in place for April 23, which was your AIF, your additional information form, the fact that you have to record expenditure against projects, and the fact that you have to do volume of projects based upon how many projects you do in the year. And if you go into that chat box, Holly will be putting a link, keeping Holly very busy today, but Holly will be putting a link there to the information about the changes that came out from April 23 and the AIF form. But now we're going to concentrate on what we need to do from the merge scheme, what we need to be aware of, some of the best practices, and what that means to you as a business. So what we're going to talk about next is R&D is always being about, or is still about, how you get rewarded for the investment that you make in advancing technology. And we all know to do that takes a lot of labour resource and a lot of cost. And that's why we claim back R&D, and that's why the R&D scheme is there, is to incentivise you to keep going. But with the changes that have come in, we've seen that value that's come back to you dramatically changed. Now, I've got Richard here is a tax person, but I'm going to ask Sean as a layman to talk us through what does that actually mean from a business perspective.
I think when you look at this screen that we've got in front of us and you can see the dates, Sam just said it's quite evident that a lot of changes happened fairly recently. And up until recently, the loss-making companies, the ones that have been most heavily affected. As you can see, the deduction down from 33% to 15% as of April last year, but there's a ever so slight change from the 1st of April going forward. But the real impact now is on profit-making companies. Ever not really affected last year, but this year from the 1st of April going forwards, we see that actually what their return is reduced down to 15%, when a couple of years ago it was up at 25%. So really what this is telling us is that HMRC are making quite drastic changes, and not really for the general benefit of everybody that's on this call. And that's something that we really need to be mindful of. You can also see it's not just those that are well-established companies that have been dealing in the scheme for a number of years. It's also those that are R&D intensive, and they've now been hit quite a bit. The threshold for that is reduced, which I know we'll touch on later on, but the threshold for that is reduced, and that is causing quite a bit of a stir as well, because many startup companies that are very R&D intensive are very much reliant on the funding coming in to allow them to grow and to survive and innovate as part of the R&D scheme. So I think probably the takeaway from this slide is that there has been quite drastic changes, and we wouldn't be surprised if we see a few more down the line as well from HMRC.
Yeah, and I think the R&D intensive coming in, and I know that we're still getting updates. I know we had some updates on that just before the Easter break on how some of that is going to work. But that seemed to have been some sort of quite a quick reaction to the backlash that the government received over reducing the R&D benefit and the impact that was going to have on startup companies. And we know that it's those startup companies that are coming up with the new innovations. And if we want to be that powerhouse, technical powerhouse that the government keep talking about, it's really important that we are supporting all businesses. We're going to go through some of the changes, Sean, but what are the two main aspects, this is going to be the next slide, Holly, that you sort of always tend to talk about? Oh, no, first of all, you're going to talk about why the scheme has changed. Sorry, Sean, I should be in
That's all
charge
right.
of my
So
slides.
why has the scheme changed? Really, because HMRC are looking to simplify the process, essentially, and simplify the process so that SME and R&D, the RDEC scheme is merged into now the RDEC scheme from the 1st of April for accounting periods, 1st of April 24 onwards. And that is really to allow there to be a clear set of guidelines for every business that's claiming, and to really get rid of any ambiguity is one of the main reasons which they're trying to steer. But they've made it a little bit more, they've opened up the rules within the RDEC scheme that were in the SME scheme. And I know we're going to touch on some of them later as well, so I won't go into that detail. But the overarching aim is really to simplify and make it easier for everybody to know what they should and shouldn't be claiming for. But that's the long-term aim. The short-term reality is that there's multiple schemes running coinciding with each other at the minute, and that's something that all of us on this call have to be very mindful of, and to be very aware of what accounting period we're talking about and what set of criteria we need to be adhering to. So in the long term, yeah, simplified and it's going to be consistent, but in the short term, it's something that we all need to navigate together and work closely with each other as we go through it.
And one of the things that we talk about quite a lot is the fact that we're now out of EU, so the UK own the R&D scheme. So being able to bring it into the RDEC scheme, which was initially a UK only scheme for all of those companies that didn't meet the EU scheme, but it will allow us to, or allow the government to really make the R&D scheme more in line with what they're looking to do from whole strategy on innovation. Richard, You've sat there very quietly for a couple of slides. It'd be really good if you could take us through what it actually looks like. So Sean talked about the high level numbers, but if you can talk about how the scheme works and how sort of those numbers then come out for businesses.
Yeah, thank you. So we've got three different scenarios here. We've got, first of all, a profit-making company spending £100,000 on their qualifying R&D expenditure. The way that the RDEC scheme works, which is what they fall into, is to take that £100,000 and give you a credit of 20%. So in this case, £20,000. And the way that the above the line nature of RDEC works is that the credit that they give you, they then tax, as only HMRC could, of course. We're going to give you a tax credit and we're going to tax it at the same time. So the way that that works and flows through is that you get a tax deduction paying at 25% of £5,000. So your net credit is 15,000. So in that situation, as a profit-making company, that's where we get to our 15% of your qualifying expenditure will translate into your tax credit. If you are a loss-making, non-R&D intensive, and we'll come on to what that means in a minute, company, then the rules have changed. Obviously, the SME relief doesn't apply anymore. But they're saying that if you're in that situation, then the calculation will include the rate of 19%, which happens to be the small company rate of paying corporation tax. So if you spend £50,000 in our example on qualifying R&D expenditure, again, you get the 20% credit, which would be 10,000, and then the tax deduction when they tax that credit is at 19%. You flow that through, then you'll get 8,100 back. So the effective rate is 16.2% for companies in that situation. Now, loss-making R&D intensive companies, they're in the best position in terms of the effective tax saving. An R&D intensive company is one who spends over 30%, 30% or more of their expenditure year on year on R&D activities. Okay, now that is expanded. We'll probably come on to this in a bit, but that is expanded if you are in a group. So that test has to be done on a group-wide basis, looking at all expenditure across all the companies in a group and then applying that 30% test. So could be a little bit more stringent if you're in a group situation. So in any event, if you're spending 100,000 as an R&D intensive company, you get the enhanced deduction, which will be familiar for those who used to be in the SME scheme, of 86%, making a total of 186,000 as a total deduction, and then we get our tax credit of 14.5%. Follow that through as a percentage of the original 100,000. That's where we get our 26.97%.
Not at all confusing then, Richard.
Not at all, no.
And I think one of the changes from that comes into place from April 24 is that threshold of R&D percentage against operating revenue or operating expenditure, which is now has gone down from 40% to 30%. And I think HMRC believes that will increase another about 5,000 companies into the scheme, which still makes it a very, very niche area of the R&D scheme. So, you know, there's a lot of testing you need to be able to do to prove that you qualify as an R&D intensive. And as Richard just said, it does include looking at you not just as an entity, but as your group. So yes, that's quite interesting and all the nuances. And I think they brought in as well that you claim under that, under the now AIF way of claiming, that you have to then opt in, that you're opting in as a R&D intensive, and then you have to provide all the evidence that you are doing so. So a bit of pre-planning is required for that. So Sean, I started to ask you this question before because I've got myself all confused, but there's a couple of things that you talk about all the time to people about um, how clients should work really from an R&D perspective. And these two are the main points that are up on the screen. Do you want to take us through those?
Yeah, so really working with us as soon as possible is really the main getaway that I'd like people to get from this slide. HMRC, as part of the compliance process, but also as part of every submission, they're really hot on who the competent professional or professionals are leading the projects, and having their knowledge and their expertise demonstrate to HMRC why this work, all the projects being claimed for, are seeking an advance in science and technology, and that there are technological uncertainties in the work that you guys are undertaking, really has to be demonstrated and documented. Now, the longer you leave that from your year end to filing the claim, that competent professional and the knowledge could leave the business and therefore impact your ability to make a claim within for that period. And therefore you're losing out on that all the hard work that you guys have done as a business. And so it's really pivotal that you're getting that information in a timely manner and working with us as soon as possible. But also we've found through our own data that the quality of the claim reduces by up to 30% the longer that it's being left past the year end. Information's being missed, unable to validate certain parts of their costs, for example, and also knowledge. Again, just recapping on that, the knowledge is left, and therefore we can't delve down into a certain aspect of a project because we just can't be sure that actually the qualifying activity actually took place in that period of time.
And I know one other thing, so we're going to come on to compliance a little bit later, but I know that HMRC are doing a lot more checks on claims, and we know that one of the things they do is www dot and then put in whatever there is you're saying that you'd advanced. Now, if you've putting in a claim that's nearly 2 years old, they'll then be looking in today's data about what you did 2 years ago. And they could come back and say, well, this is readily available now. And we know that they could go back and ask the internet to find out what was the baseline 2 years ago, but we know that they're not.
Yeah, and they are doing that. And we've seen that in the compliance responses as well. It's very obvious they're just looking at the technology that's available today and completely just ignoring the information and the evidence that's provided at the time. So as you just said, Sam, doing it close to real time as possible gives everyone the best chance of really demonstrating clearly to HMRC that the work is genuine and non-trivial in terms of R&D tax purposes.
Yeah, no, excellent. So the next slide is going to take us through some of the main changes that are happening within the scheme, and I'm going to ask both Richard and Sean to elaborate on certain parts of them. Some of them are going to be quite intense, and I have loads of questions and queries on them. So let's start with a tax one. Richard, you mentioned the word above the line. I don't know much about tax. What does that mean?
So above the line implies there's a line. Yeah, and the line is your tax line in your accounts. So if you think of your profit and loss account in your annual accounts, then you will get to a profit line before tax, and then you've got your tax line, and then there's profit after tax. Above the line implies that actually what the R&D tax credit will do is add additional income into your before tax situation. So whatever your profit is, so it's something which is added before we work out the tax line. Okay, so that's what above the line credit means, and yeah, it's been part of RDEC since it first came in. As the way that things are done, and now is obviously very relevant to pretty much everybody who's looking at R&D.
So that's why the RDEC scheme taxes the benefit afterwards, and also
Yep.
the RDEC scheme isn't state aid, which will come on to Sean's bit in a minute. But we quite often have scenarios with clients when they're starting out in business, they're loss making, they're cashing in. They have been cashing in some of the losses of their R&D, but they're still carrying forward losses. They become profitable, but they have brought forward losses, so they don't pay tax. They then go and claim R&D, and under the old scheme, there could often be situations where the R&D scheme would preserve their brought forward losses and they didn't actually get a cash benefit back. But now that we're looking at it above the line, their brought forward losses from an R&D perspective aren't taken into consideration. Is that right?
That's right. Yeah, absolutely. Number one, to draw on what you just said, you've got brought forward losses. You don't lose those brought forward losses generally in your corporation tax calculations. They will always be available until you've used them. But for this purpose, yeah, they're pretty much redundant in terms of working through what the R&D situation now means for you.
So that is good news for those people who are transitioning from profit to loss making. They'll be able to benefit from the actual R&D scheme as well. Now grants. Now grants has been one of those complicated things from an R&D perspective. How does it going to work now, Sean?
So grants as part of the SME scheme, if a company's got Innovate UK grant, for example, we'd look to have to ring fence those costs out to make it clearly evident to HMRC that these costs or this project was grant funded, and therefore in the current world and current process would go through the RDEC scheme, and anything that's not grant funded would go through the SME scheme. Now going forward for 1st of April 24 onwards, that doesn't come into effect. Everything will go through the RDEC scheme, so grant funded or not, it won't impact how you display your costs, and then we don't have to do any ring fencing out. The other point that you touched on a minute ago, Sam, was that the RDEC scheme, if you're an SME business, is not state aid, so it's not going to impact you looking to go for other forms of funding as well. So really, you can make the R&D claim and look for additional grant funding if you so wish.
That's good. So we talk a lot about grants, and we've seen that there's a lot of money that's gone into grants, especially within certain industries to push the technology. So that's great that those two areas seem to be working together from a government perspective, which is good. Now we're going to go on to the complicated bit. So Sean, I hope you've got your clever head on, because this is where a lot of the changes have been happening, and it has been quite confusing over the last couple of years with regards to subcontracted work.
Yeah.
So what's happened and what's going to happen?
So in currently, subcontractor payments are excluded from the RDEC scheme. They're only allowed for SMEs. For the 1st of April 24 onwards, both EPW and subcontractor payments can be included as part of an R&D claim under the RDEC scheme. So that's good. So that's one aspect that they've merged together. Couple of things to be mindful of though. The normal rules apply today. If they're unconnected subcontractor payments, then you can claim up to 65%. Connected would be 100%, so those rules are consistent. But if you're an EPW, they must be paying PAYE and Class 1 NIC in order to qualify and be included within the claim. And the subcontractor must be undertaking the work within the UK. They don't necessarily have to be living in the UK or registered in the UK, but the work that they're doing as part of your projects must be undertaken in the UK. And a couple of other areas that have come out with this as well as the definition of it. So if work or project is subcontracted to you and it's somebody else, another company's R&D, in the current state, you can't make a claim for that work. That's not your R&D, that's the other company's R&D, and that is consistent going forward. And the other entity can make the claim, so that is consistent, and there's no change in that. However, and I know you'll probably be keen on this, Sam, when you're going out talking to a lot of clients, is around who's actually doing the R&D. If the terms of engagement with a subcontractor of yours is for a service or terms of goods, and there's actually no general R&D in there at all, but that other entity, their R&D evolves from that piece of work that they're doing for you that actually they own and they manage, and it wasn't part of any agreement in place, and they in turn can make an R&D claim. You can see the final point about the overseas work. Now they want all work, really, all R&D work to be taking place on these shores. And I just said a minute ago that the subcontractor doesn't have to be in the UK, but the work they're doing for your project must take place within the UK. An EPW must be paying UK PAYE and Class 1 NIC. However, there is a couple of edge cases about overseas work, but they are very minutiae. There has to be a really good argument that there's no reason why the work could be undertaken within the UK. And to be honest, it's based on the companies that we're working with and the cases that we've seen, it's not really going to apply to any business that we're going to be in contact with or anybody that's on this call.
No, I mean, the HMRC's examples are a lot around clinical trials, if the participants are overseas, or if you were doing work and it included some research on something that was very geographical, but then there would be an argument of how much did you need a local expert, or how much of that could you then bring back to the UK. So a lot of planning needs to go into anything if you're looking to try and claim outside of the norm, really.
Yeah.
I think another thing on the subcontracted bit is about planning. So you as the customer, as the person who is paying for the R&D, you need to show intent on the fact that you've contemplated that there's going to be R&D when you're engaging your subcontractor to do the work. And HMRC they sort of quite use the term now contracted out R&D. So it's really important that you are really open with the people that you're working with around who's doing what and what is owned. So I think, and we've got to be able to evidence that as well. So having to have those open conversations and saying, well, actually, I want you to do this, and I know that this is going to advance technology and it's going to require X, Y, and Z. So you still need to have a competent professional with you that's telling the person who has the contracted out work what you need and what you're looking to achieve. You just might not know exactly how you're going to do that. I had another thing that came into my mind, and I was talking too much, and it's gone. But yes, I think it's all about making sure that you're planning it and you've got the evidence on it.
Could that be
Oh,
around?
that's my other. Yeah, I remembered my other thing.
Go on.
HMRC bashing again. I think looking at this and looking at some of our client base, these new rules are really going to benefit the larger companies. So we have a lot of client companies or customers ourselves who are working for larger organisations, and it won't be them that will be able to claim the R&D. It'll be the larger company that will be claiming it because they know that they've gone to an expert because they needed this expert bit to go into the machinery or the vehicle or the aircraft or whatever it is that they're making. So it's really important that we understand that really early on in your journey when you're planning who you're working for and why and how, so we can advise you up front so it's not a shock to you when you decide to do your claim 2 years later that actually none of it was qualifying because you hadn't set out in the right guidelines. Right, Holly, if we can go on to the next slide, which is going to be a bit more about compliance. We're going to talk about best practice, but why is best practice really important? It's in the news everywhere. Any of you that read the FT over the weekend would have seen a really big article on there about the R&D scheme, mainly looking at it from a startup perspective, but a lot of the issues that people are seeing with HMRC being very inconsistent with how they are managing compliance. We know that there's a much larger volume of inquiries happening, which in some ways is great because we do want to make sure that the right money is going to the right people. And we know that in the past that HMRC really haven't looked at it, and that's allowed maybe the rules to be misinterpreted a little bit more. So we know they're looking at it. Our issue really is the fact that at the moment it's not consistent, even though HMRC are bringing out regular guidelines and regular interpretation of their codes, which is their rule book. We're not seeing them actually following their own policies and governance. But what we can do to help with that is to look at some of the best practice things, which will come up on the next slide. So I'm really vain. I haven't got my glasses on and I can't see what the slides are saying because I haven't got them on my big screen. Sean, I think the first one's you.
Yeah, so the first one's start a claim as soon as possible, and that really goes back to what we were saying earlier, best practices and also the competent professional leading the projects. Now, as part of through the compliance process, but also through general submission of the AIF, HMRC really want the competent professional who's the industry expert with experience, demonstrating to them that the work is qualifying. So starting your claim as soon as possible, whilst that individual still working at the business, still has all the information to hand, is really pivotal to making sure that the claim is as accurate as possible.
Now, Richard, we've got you here to show that tax people and accountants are approachable. So why and when do you want people to approach you?
All the time, Sam, all the time. This particular one thrives off of contact. So, yeah, basically, just to reiterate some of what Sean says, the more that we can talk around this, and as soon as a project starts, or you're even thinking about a project and want to know what the parameters are, the better, all the way through to conversations which lead up to a claim being submitted. One of the things the points I want to make here is the way that we charge for R&D, that we do not charge on an hourly basis. So actually, I just encourage people who are thinking of using MPA or currently do, that it doesn't cost you to pick up the phone to us. So if I can make that point and just say that, if we're as one of your first thoughts when you're thinking about an R&D project, pick up the phone, let's have a 5-minute conversation, and that will just smooth things along. And the more that we can do that, the more oil will be on the process.
Excellent. And then going on to Sean and the process, what do people need to have and be prepared with?
Information, as much information as possible. And you touched on it earlier, Sam, that HMRC believe that R&D should be really being planned in and should be thought about up front. So you should really be setting out project milestones and really thinking ahead of where the uncertainties within the project will be, and documenting that the time spent and the information and the knowledge that you're gaining from that as you're going along. So collate as much information as you can to support the R&D that you guys are undertaking, but also be prepared with that for when we speak with you, because going back retrospectively to obtain that information is incredibly difficult, especially the longer that you leave the claim. So having that information to hand, we can include as much information as possible as part of an AIF that could really support that there's qualifying activity going on within your business.
So I know this sounds like there's a lot more work. Now, obviously, I was around sort of when R&D was sort of taking off, and I can remember talking to people back then. Some of you may be clients and on the call now, where the main concern about doing R&D was around that they didn't have the information, they didn't have the evidence, they didn't have the time to put it together. Now, 11 or so years later, the old process is now so embedded in that people can turn around claims really, really quickly. So we know that there's going to be some more upfront work for you now. But again, once those processes are bedded into your business and your practice, it's going to make claiming in the future a lot easier and a lot smoother again. So we've got a little bit of a hump at the moment with a little bit of a pain factor. We get those processes in, and I know, Sean, you and your team are there to help. I mean, it's not always about just talking to you at the end of the year anymore, is it?
No, periodically, whether that be quarterly intervals or certain points within your project, that we can just actually have a conversation, collate information there, and do it in bite-sized chunks. So it's just not such a big job that needs to be done at an end of year end and then retrospectively go back. So the more interaction we could have, and obviously Richard alluded to that a minute ago, the better. And then it's just a simpler process going forward.
So HMRC are looking at the role of the claimant, and part of that role of the claimant is about planning R&D activity, and it's also about what the outside world or how the outside world sees you with regards to R&D, and that's really relevant in one of the areas that we're finding within the SIC codes. Sean, do you want to elaborate on that a bit more?
Yeah, so the SIC codes generally, when the company started up, they apply a SIC code, which was an accurate reflection of what that business was doing or your business was doing at that point in time. But time's moved on, the company's gone in different directions and avenues, and now you're doing more than what that code actually says you're doing. And we know that HMRC have used the SIC codes to focus on areas where they believe there's non-compliance. And they're doing that and they're using that as a filtering mechanism. So I would suggest, and we suggested this previously, but please do review that. You can have up to 4 codes, and just be mindful of if someone's looking at your business, does those codes tell them of the work that your business is actually undertaking? And we know with the compliance process as well that they're kind of working their way through different areas of those codes just to see and test the water, to see how much compliance or non-compliance there is going on in there. So it's kind of an ever-moving area, but it's something you really need to be mindful of.
So we know that HMRC have sort of a few more target areas from compliance, and I know software's been looked at quite a bit because there's that thing or the misconception that all development is R&D, but actually it's really that bit that's advancing technology, that whole that is. So it's not the whole development project, it's the R&D element of it, it's the advancing technology part. But you shouldn't be scared to claim if you're doing genuine R&D, even if you're in one of the looked at sectors from HMRC. If you're doing the right stuff in the right way, you should be claiming.
Yeah, absolutely. And don't be put off by it, because we know that HMRC have kind of looked at that, applied their rules slightly differently and asking for a bit more information. But the companies that we're working with are doing genuine R&D, right? So you shouldn't be put off by this at all. It's really just kind of bedding in what sort of information HMRC are now asking on top of what they may have asked previously, and then it could just be the status quo going forward. So really do not be put off that you could doing genuine R&D, and we know pretty much all you guys on this call are, then you should not be put off by the changes in the process.
And Sean, do you want to just wrap up the last 2 bits? Because I think you've covered quite a lot of this as we've gone on, but again,
Yeah.
from your best practice perspective.
Yeah, milestones really. If it helps to work with us in smaller chunks, setting milestones and agreed dates so we can collate the information, start building up your report that will be submitted. That absolutely works for us as well. As Richard mentions, we don't charge you for dropping us an email or answer or giving us a phone call, that we can talk through and start collating information. So having milestones with us that we can periodically come back to and just piece it together is something that we're absolutely open to, and we've done for a number of companies that we work with. But the final point is pivotal: having the right people on the call. Having a competent professional leading the project is really key, and having the right knowledge and someone who can then guide us and HMRC through the process that you went through, and then we can document that information is really pivotal. And that goes back to starting the claim as soon as possible, getting that knowledge out of the right people at the right time.
Excellent. We always talk for too long, and obviously we were a few minutes late in starting, so I do apologise. But just a quick summary. the next 2 years, we know we're working through multiple schemes before we get to smooth sailing. And I think the takeaway from this really is talk to your provider regularly, understand what your current year or your next year is going to look like for you from an R&D perspective claim way. So what you're going to get, what you can claim for, to allow you to plan and forecast. And it's all about preparation and communication. And that's not just with your provider, but also with the people that you're contracting out work for, or the people that you are contracted to do work for. When you're engaging EPWs, make sure that they are paying PAYE and national insurance so you can claim. Know this up front. So again, you know that if that person can be involved in the claim. And keep as much detail and evidence as you can. But again, speak to Richard, speak to Sean, understand what is it you need to keep as a minimum to make it as easy for you. What we don't want everyone to do is to be completely overloaded with work and paperwork. So let's find a way that works for you and how you can keep everything together and recorded. Keep yourself up to date. It is ever changing. So keep up to date with us. We put all the regular changes out on LinkedIn, on our social, and on our website. So use some of the QR codes and the details of Holly will put in on the end to get some information. But we can start with some questions. I think that's the next slide, isn't it, Holly? Yes. Questions. Now I have one here. It says, what are the criteria for the expenses to qualify for R&D tax credits?
Same as what they have been before. So we assume with that they mean what areas can qualify, and that's payroll and outsourced labour, which is subcontractors and externally provided workers, which we touched on, and how those rules are being applied in the merge scheme from the 1st of April 24 onwards. Any material costs, as long as they're scrapped or destroyed, as part of the project, any software like licenses, and for the 1st of April 23 onwards, that includes the cloud hosting and data licenses and utilities. So the costs there's no change to what can and can't qualify in terms of the costing criteria from last year's changes.
Yeah, as long as they're relating to that qualifying activity.
Yeah.
Another question that we've had here is, what can trigger an inquiry? So I know before it was always thought if your claim was really big, it could trigger an inquiry. What's triggering them now?
To be honest, I don't think anybody definitely knows what's triggering an inquiry, and when I say that, I don't want anyone to gasp and think, oh no, it could be me, but it could be anybody. It could be a large fee, is it a large amount of costs, or it could be a small amount of costs. They're just working their way through different sectors just to understand what compliance and non-compliance is going on in that area. So there's no one reason, or a number of reasons is what we could probably put our finger on a couple of years ago. So what would possibly put you into compliance, that might actually put you into compliance at the moment in time. But leaving it too long to make a claim and not having quality information is definitely the main reason that can put you into compliance. So getting your claim up to date is something that we know, and we've seen with companies that have gone into compliance, that the longer it's being left, there is a larger risk of it being in compliance. So working with us as quickly as possible is something that we do know that we should be doing going forward.
Right, so we're sort of running out of time, so sorry if anybody's got to leave, but I've got another question here. And Richard, you touched on this before, but so either between Richard and Sean, how does a group qualify to be R&D intensive? So I think
Okay.
that's talking about the percentages.
Yeah. Okay. So it's the 30% test. Okay. So that can be on a standalone company if that's all you have, but for a group, you have to look at all expenditure across the group. You can ignore expenditure between companies, so intercompany situations, but apart from that, everything that is an expenditure line within the whole group has to be considered, and the 30% test measured against that. Which means if you have an R&D focused company and the rest aren't, um, then that is a hurdle that you need to consider and get over.
So you could have one company in the group that is, say, 70% R&D from operating costs, and then two others that are only about 10%. So their
Yeah,
net value is still going to be over 30%. So all three of those companies can benefit from being R&D intensive because the group is over 30%.
potentially, yes. It comes down to numbers. Yeah,
Yeah.
so percentages are one thing. Yeah, 10% of a very large number. Um, yeah,
Yeah, but
you,
yeah, added,
yeah,
yeah, added on a simplistic basis. And then it can
yes,
happen in reverse, couldn't it? So you could have somebody that is actually at 30%, but then because other companies in the group maybe aren't doing any R&D at all,
yeah,
that 30% of their entity put against the group would mean that they'll
yes,
come below 30% and they would lose the chance to claim as R&D intensive.
absolutely.
Right. I don't think we've got any more questions, and I know some people are leaving, so we have run out of time. But if Holly, if you want to go into the next slide, it's just a couple of QR codes. We will be sending everything out to you afterwards, so you can. That's how you can access some of the information that are on this scheme changes, the AIF form, and the 2023 changes. And then the next slide gives you QR codes to follow us on for emails and to LinkedIn to keep up to date with everything. And then the next slide, rushing through now. I won't tell you about the nightmare I had with QR codes last night, but that's how you can contact me. So if you want to get hold or spend any time with any of our experts, drop me an email. If you're an existing customer, speak to one of your relationship managers. You can have some time, talk about your projects, talk about what you're planning to do. If you're new to us and you want to understand if you should be claiming and how you should be doing it, or if you've claimed elsewhere and you want to verify that you are claiming correctly, then let me know and I can put you in contact with the right people and we can have a chat about it. But thank you all for attending. Richard, Sean, I hope I didn't give you a heart attack at the beginning when I just disappeared for about 10 minutes.
Just a
Um,
mild
Smile and
Thank you,
wave.
Holly, in the background.
one.
But yeah, and thank you everybody for joining. But please, if you've got any more questions, do get in contact. We'll send information out to you all. Have a good day.
Okay.